Hi everyone, it's another digital whiteboard session with me today. Today we're going to look at e-commerce and specifically unit economics in e-commerce, what that means in terms of results for your business, for being able to raise funds for your company, and also quite frankly why there is a hard in hardware. Or maybe this is giving a little bit of perspective into what we're going to discuss, because e-commerce hardware is very challenging to make work as a new fledgling business. Now let's have a look at why that is. Well, let's jump right into it with a unit economic analysis. And obviously I may be missing costs that I should be considering, and everything I have here is just a rough approximate number, but I'm relying on numbers of what I've seen with my customers, what I've found online, and what I've experienced when I built my first e-commerce business. And so let's have a look at it. Let's assume you're already in the higher priced category for your e-com product. Let's say the sale price is 100 USD. Well, what happens right away is that you have certain direct costs that are going to leave your pocket. The first one is value-added tax. It's obviously going to be different in different countries. I'm from Switzerland. There it's somewhere between 7 to 8%. In Germany, it's I think roughly 19%. I'm not sure what the specific figure is or percentage is in the US, but let's just go with 10%. So $10 right out of your pocket the moment you sell something, assuming you include VAT in your sale price, which is not commonly done in the US. I think is even a must-have in Europe, and I think just is more customer-friendly. I never understood why Americans are not doing it. Well, anyways, next cost item is payment processing for platforms like Stripe. They take, I think, 2.9% is the current pricing of Stripe plus a fixed fee. I think it's 30 cents per sale. So another $3 are leaving, again, your pocket just for you to be able to sell that thing. Obviously, in order to get to the point where you can start selling something, you have to pay for manufacturing. Let's assume it's 15% of the price here, so about 15 USD. You have to get the product from where it's being manufactured, for instance in China, to where you're based. I'm going to assume that that's around 10 USD for the shipping cost. It could be a little bit less depending on what your agreements are, how heavy the product is, how large the product is. There are obviously lots of variables here that will influence the cost of logistics and shipping. And then you have to store the entire thing. I'm assuming it's going to cost somewhere around 3 USD. And then comes the biggest cost, which is customer acquisition. You have to pay for people to buy your product, either by directly advertising on Google Ads, on Facebook, on Meta, on TikTok, or you have to pay fees on a marketplace like Amazon or whatever the local alternative is that you could be listing on. You will have customer acquisition cost. What I've most commonly seen is that for a product that sells at 100 USD, but quite frankly, for any product that you're trying to sell online, it's somewhere around 10 to 30 USD a customer acquisition cost. Obviously, that's a pretty broad range, and I'm sure at the outliers there is even more variability here. But let's just assume it's 25 USD, another major chunk. And then at that point, you have to get the product from where you are to the end customer, so last mile delivery. And all of that adds up to a staggering sum of 76 USD, leaving you only 24 USD in terms of whatever you want to call this, some kind of a margin. It's not your gross margin, it's not your net margin yet. Maybe it's also not the operating margin. I'm just going to say it's 24% margin at this point of our calculation. Let's just go with it. Now, careful, we're not finished, right? Now come the tricky things. First, you're selling online. Most people, especially in fashion, want to try the products that you're selling and may not be satisfied with what they got and want to return the thing. It's actually pretty common. I'd probably say 5% are going to be returns. And so that means you have to get the product back to you so that you can sell it again. You have to ship in an alternative product, depending on whether it's a consumable or not that you're shipped out and it has been opened. Maybe you can't even take back the old product and just need to replace it. Depends on the context. And obviously you need to pay the shipping again. And what I've experienced, I'd be curious about your experiences. The mail company taking back a product from a consumer and returning it to you can or effectively is more expensive than the 10 USD that we have on top for shipping to the consumer. And in case of returns, you have to take it back. Let's assume it's 15, and you have to ship it out again. That's another 10. So we're at 25 for the return back and forth, which kills your margin already there, and you're at 0% and you have a loss maker. Now, obviously, once you have accounted for returns and any other costs that I may have forgotten here that are directly attributable to the product that you're selling, you will also have indirect costs. Indirect costs include things like the salaries for your team and for yourself, the benefits that you have to pay for, licenses to subscriptions, the rent, utilities, insurance. It's going to be very, very hard to cover all of that cost on $24 over margin on a sale of 100. And if you're not selling a product that's at 100, you may have no margin left whatsoever to pay any cost. Because let's assume you're selling a product that's priced at which is what many people do, which many businesses do. It's priced at 50 or even 25. Well, practically, you cannot run an e-commerce shop on those margins, which is why these types of products would more likely be sold through the shops of other people or on marketplaces. But in that case, what would happen is, if let's assume you sell a product for 25 USD, just your customer acquisition cost is 25 USD. How are you going to cover that cost? It's impossible. Now, so that's the indirect cost that we need to think about in e-commerce. In addition, you also have supply chain considerations that you need to bake into maybe not your pricing and the unit economic analysis, but your overall strategic rationale for how you're going to run the business. First of all, you may find that the inputs that go into producing your product suddenly are in short supply. Especially during the pandemic, we saw that simple things like wood all of a sudden were hard to procure, and that could have material impact for you to be able to sell product. The next one could be quality. When I built my first e-com business with a buddy out of school, we were in a space where every individual product, while we were selling it for a high price, was hand manufactured somewhere in Italy or in Spain. And hand manufacturing leads to broad variability in terms of quality. Even if it's acceptable quality, in our case it was a shoe, what you may find is that different manufacturing styles slightly change how the shoe fits, and then you are in a tricky space because you cannot even give proper guidance to consumers in terms of what they should expect, what the product feels before they get it, which again increases returns. Now, next is shipping. You may get your product stuck in custom controls. It's the physical supply chain that makes it kind of unique here, which you do not have if you're building a software or an IP-based or a content-based business. Now, the next one, and that's the last one to be careful about, is demand fluctuations. You will have swings in, for instance, seasonality. That's a common supply chain management challenge that you would work through for larger organizations. In your case, what that likely means is that you will have to get inventory. Inventory means capital expenditures. In any case in e-commerce, you will have much higher capital expenditures than in any other type of business. You have to get inventory before you can sell, unless you do drop shipping. But drop shipping is not that easy either and comes with its own challenges. And so you have to get the capital somewhere in order to push it to your suppliers and to your supply chain, and at a later point collect money from your customers. But that could take time. Now, what is the result of all of this? Both the direct cost, the returns, the indirect costs, the supply chain considerations, and the demand fluctuations is that the average profit margin of an e-commerce business is just 10%. That's per Shopify. The average profit margin of a software business could be somewhere as high as 70 to 80, potentially even higher than that, which is why software is so attractive to venture capital investors. And that's the second bullet point on the results that you're seeing on my whiteboard here. Investors do not like e-commerce for what we're looking here. This is the specific reason. and they tend to stay away, which makes the lives of founders that are trying to build and scale an e-commerce business very, very challenging. And I've experienced it myself. For us, it was practically impossible to raise venture capital. The exception were some angels that had like an emotional or a professional, deep professional connection to the product that we were building and were interested in the space. It could also be that strategic investors may go in. So for instance, if you're building a fashion business, then maybe a fashion brand wants to invest. But pure play institutional capital investors, the traditional venture capitalists, will likely not be interested in an e-commerce product itself. E-commerce infrastructure like Shopify, payment processors, all of that is super interesting. But that's a different topic. Now, strategy, just some random ideas for what you could try to do to maneuver and navigate some of these issues. Let's go through them. The first one is that you obviously want to optimize the conversion rate of your store. This is called CRO, conversion rate optimization, and you effectively just want to get that customer acquisition cost, which is 25% of your total price that goes right out of the window, as low as possible. And that's where CRO comes in. Second, I don't think it's viable especially if you want to go DTC, direct to consumer, on your own store to sell a low price product. You want to come in with a premium product that you can price at a high point, or you just want to increase your prices for your current product. That's the second one, and I think that's always advisable when you want to sell a direct to consumer. The third one is that you cross up and resell as much as you can. For instance, on your checkout page, make sure that your store has the capability to show, hey, why don't you buy this one here? Or bundle up the products right from the beginning. Hey, you can only buy this product together with this other product. It may not be such a great user experience, but it could at least reduce the cost of shipping, for instance. And also the customer acquisition cost being amortized across at least two products that are being sold. And the last idea here for cross-up and reselling is that you sell subscription boxes. There are tons of subscription boxes. The great thing is you sell once. I guess you acquire your customer once, you sell multiple times. That's what I'm trying to say. And then the next one here, bullet point number, where are we? 1, 2, 3, 4. Push shipping to customers. Obviously, you could try to push some of the costs that you're having, for instance, the shipping and also the returns to customers. After, I think Amazon kind of ruined that game, that after a certain order volume, you just have to cover that cost. It's in the heads of consumers. You could still try it. It's just going to impact your user experience or your customer experience. So that is something to be careful about. Second to last, reduce your dependency on ads. You could try to drive traffic organically, obviously very challenging, but you could use methods like search engine optimization. You could try to do social media marketing, either on your own or with influencers. And ultimately, you could also try to get listed at retailers. Now, listing at retailers is a whole different topic. It's very painful too, and it's going to cut pretty deeply into your margin too. It's definitely not for free. In fact, it may end up being the same customer acquisition cost or even higher. But potentially, if you find the right partners, it could help you in getting to market in a cost-efficient way. And then lastly, obviously, the indirect costs that I mentioned, salaries, benefits, licenses, etc., these are directly under your control. You want to keep them as low as possible. Run a lean team. Pay them ideally below market. It's obviously not ideal to hire top talent. You will have to find the right balance here. But you may also not want to rent the fanciest offices that you can find until you found a repeatable playbook that lets you sell your e-commerce product at margins that are healthy and generate cash flows that are good for you. All right, that's it today. I hope you found this useful, sort of this deep dive in e-commerce and what makes where the heart and hardware is coming from as far as e-commerce is concerned. Any questions, shoot them into the comment section below. I'll always be happy to get back to questions. Leave a thumbs up if you enjoyed this video. It is a great signal for myself, and do follow the channel if you want more of this content. If it's been interesting for you, I do publish regularly. Great. Have a great day and talk to you soon. Bye bye.